Joining me now, Wells Fargo Senior Global Equity Strategist Scott Wren. Hey, Scott.
Morning, Lauren.
This volatility is starting, dare I say it, to feel a little bit boring or prosaic. What's with these moves every day?
Well, I think you can boil it down to just a couple of events. One is, and we've been talking to clients about this all year, is the Fed going to make a mistake and is global growth going to slow down? Now, there's a lot of underlying moving parts, whether it's trade friction, whether it's Brexit, whether, it's a shutdown, whatever. But the issues that overall are really pushing this market and have struck fear into some investors is Fed mistake and global slowdown.
A lot of people say if they reinstate the uptick rule, especially when stocks are selling off in a big way, and failure to have that rule compounds the losses, that reinstating it could smooth out some of this volatility, especially when the algorithms and the computers are involved. Your thoughts?
Well, it could, and there's a lot of people are talking about algorithmic trading right now, which clearly, that's a decent amount of the volume. But really, when you look at it over the last year and a half, just your good old-fashioned trend lines, technical analysis, there's a lot of activity around those levels, and really when you watch it trade around these various levels, it's just good old-fashioned technical trading, whether it's algorithmic or not. So I think obviously that pushes a lot of volume. You're quicker on the trigger and those kinds of things. There is an effect on the market, but for us, it comes down to fundamentals. Are the forward fundamentals good or bad? And for us, we think we'll see good GDP growth, not great, but good GDP growth here, decent growth abroad, not much inflation, and from these valuation levels, stocks look pretty attractive. And this cycle, there's been a lot of things that were not typical in this cycle, but as you move into these later stages, the final third of the cycle, things like inflation, Fed raising rates, tight labor market, global growth. Those are concerns that happen later stages of every cycle that causes volatility to increase.
Is there inflation,
I would argue
though?
that's not all that common. I'm sorry, Lauren?
Is there inflation, though? You can argue
well, there's
that
not.
there's deflation right now.
Yeah, there's really not. That's one thing that is a factor here is inflation. There doesn't seem to be much inflation pressure. We certainly don't expect any, but one could argue certainly that the Fed and what they've hinted at their rate hikes, they're afraid of inflation, which seems kind of odd to us. But not much inflation, decent growth. Valuations from here look pretty good. So for us, we want our clients in stocks. We want them stepping in here. Easier said than done, though, for retail investors.
Scott, the last couple of days, you had the Christmas Eve sell-off, then you had money step in. Didn't seem like to be a technical reaction. It seemed to be like money was actually stepping in. Now, after that point, you could have that exacerbated some by the algos that are going forward. But yesterday, also, you had sell-off, you had money step in. Is this, to you, a bear market bounce, or is this very bullish signal that money is stepping in and trying to find value?
I would argue that Monday had a real panic capitulation type of feel to it. We closed on the absolute lows. We closed right above a big trend line that comes in from the 2011 low in the S&P 500. So I think on Wednesday we saw a massive short covering rally because, let's face it, this move down happened fast. There were a lot of people that jumped on the down train way too late, and so we saw a big scramble there. And really, yesterday was an ideal trading day. We would have liked to have seen really what happened yesterday. We thought, okay, we're going to cough up a little bit of this early, maybe 200, 300 points in the Dow, and then to finish positive on the day would have been a good technical indicator that, hey, this bottom's in place or we're awful close to it. And really being down 600 points plus in the Dow and rallying back, and really in the last hour and a half and closing positive, if you're a trader, that's a pretty good sign.
Scott, it's been almost 50 years since you've had companies come in with 10% plus earnings and have a pullback like we've had. 87, you had this. 2011, you had this. Is this an aberration of the market, or is this more of the political uncertainty that's going on out there rather than just the Fed and the slowdown that's coming?
Well, political uncertainty is playing into it, but I would say, this very partial, very partial shutdown, I don't think that's all that big of a factor. The bigger factor are these macro issues and what's typically happening late in a cycle. Is the ECB going to start to tighten, which I'm not sure why they'd want to do that, but are they going to start to tighten? Is the Fed going to go through with 2 hikes next year and, 1 in 2020? Those are the kind of questions that are going to drive the market, or the answers to those questions are going to drive the market over the next year. That's what we're trying to figure out. We think we're going to see some decent global growth. That needs to happen for us to reach our earnings expectations and for the market to work its way higher. But we're looking for good returns here in 2019, and really I think that's what's likely to happen.
Many people blame the Fed and Jay Powell for scaring the markets. It was October 3rd, actually, which was the start of this downturn that we've seen. And I know Kevin Hassett tried to tell everybody and calm the markets. Powell is absolutely 100% safe at the Fed. And we did move up a little bit on that. And now there's talk of a sit-down between Jay Powell and President Trump. So my thoughts are, A, how much do you think this sell-off that we've seen, not this week, but the sell-off in general, is the Fed? And B, what is a meeting going to do?
Well, we think quite a bit of it is the Fed, or fear about what the Fed is going to do. Now, the meeting, the president's entitled to his opinion, and clearly President Trump is going to state his opinion when he has one. But as Jay Powell said, and we firmly believe, the Fed is not looking at what the president might be saying or anyone else might be saying when they make their decisions. And do presidents meet with Fed chairs? Yes, they do.
Privately.
And yeah, that's true, privately. And I think that's a good idea. They should be in contact frequently. But the Fed is an independent organization, and I think it's been blown way out of proportion to think that the Fed is going to be influenced by not just the president's opinion, they certainly hear it, but by any political opinions. That's not what these guys are trying to do. The best job they can do given the conditions that they see. And it's a tough job. You're trying to fine-tune a $20 trillion economy. It's not easy, but it's our firm belief the Fed is independent. Now, whether they make a mistake or not, that's a whole different question.
Right.
But I don't think they're going to be influenced by the president.
They're also orchestrating quantitative tightening at this point, so there's a lot going on. But the Fed doesn't seem too worried about the health of the economy, nor does the White House, even though the market does. And yet we got to read.
Lauren, our number is 2.7 for 2019.
Oh.
So is that going to be slower than this year? Yeah, it is. I think the Fed's too low, at least based on our analysis, at 2.3. So we're a little more optimistic than that. And that's good growth. It's not great growth,
but
it's certainly
aren't.
good.